Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today, we're going to look at Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. So I'm just going to fire away, shoot my opinions off when we see certain things as we go through. So let's dive in. Let's take a look. If you want to follow me, it's at Finance. If you want to join our community, finding-value.com is where I get to business with individual companies, how to play the commodity bull market in any of these sectors. So HFI research says, wow, I'm surprised by the strength in U.S. oil demand. So 4-week average for U.S. product supply of petroleum products, making new all-time highs for this part of the year, looking pretty strong. I thought we were in this huge recession and it was going to impact oil demand. Well, we can slow down in the markets, but usually oil demand stays pretty resilient. So we can have a slowdown in certain sectors. It definitely can work out like that, but oil demand can also still go up irrespective of that. But a lot of people tell me that electric vehicles, they're going to come in and completely destroy oil demand. That just hasn't happened yet. So not yet. JSG, latest EIA comparative inventory analysis as of 7/10/24, total commercial stocks ex other oils is up 2 million barrels. Wow, WTI fair value of $74 or $8 overvalued in his opinion of where we're at today. So that is the dot plot for our commercial inventory level and where we are trading today. The silver junior miner chart made simple, and this looks really interesting. What he's got here is a launch pad where we could potentially break above this big bottoming pattern. We break out of that pattern, we could use it as a launch pad. So that's the silver junior miners, 9 years in the making. I do think that the market conditions are conducive for this to occur at some point in the near future. Hopefully near future. Hopefully it doesn't take too long. But generally when the yield curve uninverts, and I don't know if we'll get an uninversion immediately, a lot of people are trying to predict a recession. They're trying to predict the yield curve uninversion, et cetera, et cetera, et cetera. All I know is that this is a huge asymmetric opportunity. And the asymmetry is what gets me so interested. So I like to buy things when they're cheap and then ride them to the moon. He's got the moon up there. If you guys didn't notice, that little moon up there. Ride them up to the moon and pocket those gains. But you know what? It does take some time to get there. But that looks really good for silver junior miners. Just a frugal scientist says, 401k folks, what is your largest holding and why did you pick it? Low fees, high yields, low risk. Well, I don't base anything that I do off of this. Obviously, you want to get something with low fees, but that's not the sole reason I buy something. It's not high yields are not the sole reason, and neither is low risk. You could say low risk with the timing of the purchase. So I mitigate my risk by buying assets that are down. That is what I consider to be low risk. Volatility in a ETF or a sector isn't risk in my opinion. So my largest holdings, and why did I pick my holdings? It is based off of what is cheap and the market conditions where the tailwinds are behind those cheap assets. Risk is associated, in my opinion, with when you buy something. So when someone says, oh, well, is that low risk? It's like, I don't know how to answer that necessarily, because a lot of the companies that I enter, they could be high risk at that point, but I'm buying it at a low risk area. High risk is determined by how much debt a company has and the potential of it going bankrupt. A permanent loss of capital is risk. The way that I view risk. What is the risk of me losing my money? And if I can control that risk by buying it at a low sentiment area that people don't want, and the company is solid, and I think that the tailwinds are going to change from headwinds to tailwinds for the company, that's when I get in. That's how I make all of the money. So my largest holdings are an extension of where I think a good entry point is. And then I start to evaluate how much risk does the company have and how much upside potential does it have. So if I'm at a very low risk entry point, I want to take on riskier companies because the symmetry is generally higher in a company that has debt versus a company that doesn't have debt. If they've got debt, they get sold off further to the downside. If they don't have debt, generally that is a pretty robust company and they don't give you as good of an entry point at a low risk entry point where everyone's selling off and there's fear in the market. So my largest holdings are an extension of what I think are the cheapest and have the best tailwinds behind it. Joseph Brown says, no, Powell did not say he wants to see housing prices reset to pre-pandemic levels. He said he wants to see mortgage rates get back down to help with the affordability of new mortgages. Do you think a drop in rates is bullish or bearish for housing prices? I'm in the bull camp, guys. I know a bunch of people that want to buy homes, and they're basically waiting for affordability to get better through interest rates. It says, but I would also say that the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is still a housing shortage, Powell added. That right there tells me that Powell knows about the real estate cycle and that he basically put his foot on the neck of the housing market, raised the affordability to levels that he, I think, thinks would slow the housing market down, and it absolutely slowed it down, totally. But he also knows that we've got a housing shortage, and he also knows that the affordability is basically the lever of turning it on and off. So that's where we're at. That's the reason that home prices continue to go higher. It's the low inventory levels. And I don't think we're going to get to a level where the housing market is going to cause a recession, because I think Powell's going to lower rates before that occurs. That is an opinion, and we'll see if he can pull that off. I don't know if he can pull that off. I don't know if he'll be too late. But in my opinion, home prices are going to surge if rates drop low enough. If they drop low enough. And he's probably going to try to dial it in and out based off of where rates are going to be. So he might lower rates a little bit, get the housing market to kick back up, and then he'll probably hold at whatever rate that is that kicks the housing market back up. Here's CCJ with the breakout today, looking pretty good. So you uranium guys, I know we've got a lot of uranium viewers, might want to get interested here in some of your favorite names. And I can help you with certain names if you want to go on the website. In my experience, most people who are lucky enough to sell something before it goes down gets so busy patting themselves on the back, they forget to buy it back. But they forget to buy it back up. But what I would say here is, and me kind of researching a lot of these guys like Buffett, Lynch, and some of these other guys, it's about asymmetry. It's about holding time frames. They hold for a very long time frame and they identify great entry points. So that's kind of the mix that I'm trying to incorporate into my own investment style. Because these guys made a lot of money, and they're talking, 200 baggers, 300 baggers, and really good entry points where they buy something cheap and they just sit on it for 15 or 20 years or longer. That's crazy in my opinion, but you can't beat that return making that type of money in some of their investments, not all their investments. Emerging market equities are trading at 50-year lows compared to U.S. equities. I love this, guys. I love it. Look at the 60s here. And it stayed cheap for a little while, though. That's the only negative thing, is it stayed cheap a little bit while in history. I don't know if we're going to stay cheap for a little while or if we're going to get a reversal like it did in 99, 2000 here. I'm not sure, but we'll find out. I do think that emerging market equities go up when the dollar gets weak. And the dollar generally gets weak when rates go down. So that could be a catalyst. It could be. But we saw emerging markets outperform during this era and rates were going up in the 70s. The B of A global wave is currently signaling an upturn in economic cycle, which I think is interesting because we have an upturn in an economic cycle, and that's global wave, which that just screws with my mind because I got so many people on Twitter telling me that there's all these slowdowns and indicators and stuff slowing down. Here's silver, nothing to do but sit now as we've broken out of that resistance level. And yes, that's what you do when you break out, guys. You just sit and don't do anything. You make all the money by sitting, not trying to trade or get pretty here. Let it make you money. Let it rip here, guys. What if we get to $100, $200, $300, $100 plus? I do think that's a high possibility. And we're like right in the wheelhouse of the headwinds changing into tailwinds here, where if we get lower rates, I think we're going to be off to the races. It's going to be a fun little ride. LNG investor, BP's 2024 energy outlook. In the current trajectory, LNG demand growth will require 300 BCMA of additional liquefaction capacity to come online post-2030. So their trajectory here in LNG traded volume is like way up. And the net zero is this going back down. I don't think that's right, guys. I think the current trajectory is probably going to be the right one. Net zero, I think, isn't going to go through, at least not in the size that most people think. We do have, it's basically a wash, slight deficit or slight draw for crude oil, Cushing, gasoline, and distillates. So we did go and we converted it into distillates. We didn't yank it from there. So a little bit of a draw here if you add it all up and do the math. The rapid transition narrative is crumbling, so BP raises forecast for oil and gas demand as clean energy switch slows. So they say the transition to clean energy has slowed. We've got renewable power sources such as wind and solar fail to increase at a fast enough pace to keep up with the growth in global energy demand. So BP warned that delaying the clean power transition could be costly, as it said oil would continue to play a significant role in the global energy system for the next 10 to 15 years. And they're just going to keep extending that out, is my guess. Here's Tavi. So let's read what he's got here. The response of policymakers during the pandemic marked a pivotal moment in history. Since then, we've been experiencing a macro regime shift that manifests in various ways. Inflation has resurged, interest rates have bottomed out, and commodities have ended a long period of decline. Deglobalization has escalated. Central banks have initiated a gold rush. Safe haven currencies like the Japanese yen have collapsed. Political populism has resurged, and inequality issues have worsened, among other developments. The chart below is a simple example of these developing trends. After a major breakout, overall commodity stocks have been consolidating for some time. A second upward move is likely upon us. Here's a big consolidation here. The breakout, we've been consolidating sideways here, and hopefully we're in another wave higher for commodity prices. Oliver Grab says this visualization and prediction is still hard to believe for copper. So this is 700 million tons of total coppers produced over the course of human history. And if we want to go to net zero by 2050, we need to produce 1.4 billion tons new copper needed to reach net zero by 2050. Is that possible? I don't know. I don't know if that's possible. I'm making the bet where I'm investing in current infrastructure for way higher copper prices. But I also don't think it's possible to produce this amount. I really don't. Here's platinum versus gold, and you know I'm the ratio boy. Platinum has now broken out big time, just like gold has. And this ratio chart has a 22-year perfect bullish falling wedge. If gold is a 7x from here, imagine where platinum will be then. This will be a bull market that you just cannot miss. So this is when prices for this ratio chart moves up, platinum outperforms gold, and we are waiting for that outperformance here, hopefully very soon. Goring and Rosenzweig says, we turned bullish on North American natural gas market in 2020. Despite recent setbacks, our research indicates a potentially stronger rally ahead. We believe the turn in natural gas is here. Read more about it. Average annual natural gas production growth, boom, boom, huge growth in natural gas production. And I don't think that they believe that we can just ramp natural gas production up to infinity. And I think that's kind of what the market expects over the next 10, 20 years. So we might have an interesting development on natural gas production and how fast we can ramp it versus maybe all the demand that we're putting on for electricity and heating constraints and LNG shipping capacity. The move in precious metals miners have only just begun. The charts are now set up to climb the right side of a huge rounded bottom. Most will not get into a bull market mindset until it's too late, though. So for heaven's sake, be one that does not miss the move of a lifetime. This is GDXJ Gold Miners monthly candlesticks. We've broken out and we've got a long way to go higher. We've got the expanding falling wedge, a very bullish pattern, and the massive rounded bottom arc cup in the making. So we've got a big move potential in GDXJ. North Star charts, he's sharing this chart. It's a ratio chart, Dow Jones versus gold. It says this chart can give us a very good early indication of where gold, silver, commodities in the stock market like SPX are likely to head. And we have broken to the downside of Dow Jones to gold ratio. And that occurred in 1930, 1971, and 2001. And you know what accompanies this? Commodity bull markets. Commodity bull markets they ripped very close to 01, very close to 71, and 1930, where we had a revaluation of gold. So we've got 2024. We've broken to the downside here. And he says this is a quarterly candle chart. That means each red or green candle represents 3 months of price action. The current candle is red and closes at the end of September. If it remains below the red line at that time, we have a quarterly breakdown. That would imply an increasing likelihood of the S&P 500 falling 50% or more and gold rising hundreds of percent. Yes, yes, and more yes. So I do think that's a high probability, and I am positioned for that outcome. Here's another one, the very big picture. This is from Grady. It shows that silver is breaking out plus backtesting versus the S&P 500. A historical global asset class rotation is in the making, away from overvalued paper assets towards undervalued hard assets. And it is now about to accelerate. So when the price for this ratio moves up, silver outperforms the US stock market, and we are in position for that to occur. So I know there's a lot of people that are probably chasing the S&P 500 NASDAQ. Good for them. Maybe it goes up a little bit longer. But here, this is signaling that we have way better valuations in gold and silver. Silver here specifically, and that we're about to see a mind-blowing move for silver and gold. But again, it may take some time. Patience is required. Morgan Housel says, if you're a long-term investor, the odds of experiencing a crushing bear market and a recession are 100%. Yet so many act surprised and shocked when it happens. We've got global oil markets will be in supply deficit next year, according to EIA. So that's also a good thing if you're an oil investor. Here's another one from Warren Buffett. He says, our investments continue to be few in number and simple in concept. The truly big investment idea can usually be explained in a short paragraph, says Warren Buffett. We also have here a crash alert from the Great Martí, 1929 versus 2024. a perfect 465% rise depicted on both charts from the lowest point of the broadening bottom formation depicted to the top. Scary. So he is looking at this broadening formation at the bottom there. That's the red broadening formation, another broadening formation. The big move higher, and then the subsequent crash lower. I do think that is a high likelihood of occurring, is a crash in the future for potentially the stock market. Now, I don't think it's going to be as big, perhaps. That was a deflationary housing crash. We don't have that same setup, but we could see an underperformance of the S&P 500 and NASDAQ. And that's what we've got for today, guys. So I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.